Welcome to my market commentary for the third quarter of 2022. We'll be talking about the markets, stubborn inflation, and absolutely huge news on the latest shape of the yield curve. Let's jump in. Hi, I'm Joe Macek, and contrary to many finance YouTubers out there, I am a licensed investment advisor and portfolio manager for IA Private Wealth, helping guide and counsel investors for over 22 years. Welcome to my YouTube channel, Investing Made Simple, where you can find the most trusted information on building your net worth. In this quarter, the Fed continues to be consistent. With its hawkish interest rate approach to get inflation under control, the markets continue to decline with several bear market rallies now taking shape. The 10-year minus the 3-month yield curve has officially inverted, putting us on recession watch for the next little while. We examine the current Fed balance sheet, current savings rates vis-a-vis cash balances of consumers, and take all of this and try to put it together for a forecast for the next 12 to 18 months. But as always, before we get too deep into the video, I'd like to go through my usual disclaimer. Before you make any decisions surrounding your money based on any video you see on YouTube, please take the time to consult with a fully licensed professional or feel free to reach out to me on a one-on-one basis. The other thing you need to do is completely shatter that like button for the YouTube algorithm. Yeah, just hover over it and darken it. Leave a comment in the comments section below, as it really helps out my channel. And if you happen to like my content, please consider subscribing and ringing that bell so you can be notified when I upload such hypnotic content such as "This is the ultimate indicator of collapse" and "Investments that stay green when the markets turn red." Did I say hypnotic? Yes. Hypnotic. Okay, now back to our video. When we left off in our last commentary, the Fed, true to their word, has aggressively raised rates. March and May had 25 and 50 basis point hikes, followed by 4 more very sizable 75 basis point hikes in June, July, September, and November. This, along with the balance sheet roll-off, which nobody is talking about right now, has had a tremendous impact on liquidity and subsequently the markets. The Fed continued to roll off the balance sheet aggressively, along with hiking rates at the same time, maintaining their hawkish stance at every opportunity by ensuring everyone knows that they are committed to crushing inflation once and for all. However, we have seen this movie before in 2019, and it didn't bode well for market returns. I suspect the same will be the case this time around, albeit with a slightly different path. More to come later in the video. When we look at the upper range of rate hikes on this Fed chart, you can see how steeply rates have risen, and the balance sheet has also come down from almost 9 trillion to a little over 8.6 trillion at the time of this writing. It is estimated that in addition to the Fed funds rate being hiked 3.75% this year, the roll-off on the balance sheet has added what I like to refer to as shadow hiking by the Federal Reserve. These are quantitative tightening moves by the Fed that have the impact of additional rate hikes, but without the official announcements or meetings that usually accompany them. Rate hike equivalents that are there, but you can't really see them, or shadow hikes. In fact, if things go according to plan, the Fed will have removed more than $522 billion from the financial system by the end of 2022 and another $1.1 trillion by the end of 2023. It is estimated that by trimming $1.5 trillion off the Fed's portfolio, it's the equivalent of hiking interest rates by up to another full percentage point, according to estimates from Luis Alvarado, Vice President and Investment Strategy Analyst at the Wells Fargo Investment Institute. So with the actual Fed rate hikes and the quantitative tightening or shadow hiking taking place, by the end of 2023, the combined equivalent interest rates could have the effect of being around 5.25 to almost 6%. That is a staggering amount of restrictive policy for the markets to digest in a 24-month time frame. This would likely explain the next chart, one I personally follow almost every day, the 10-year minus the 3-month. The downward slope and speed of this inversion is one of the fastest I have witnessed in my career, and it seems to be in lockstep with the speed and aggressiveness of the Federal Reserve. As you can see, the inversion of the yield curve in prior years took much longer to materialize, but this time the curve inverted quickly and very deeply as compared to other times in the market. This is all consistent with the Fed's mandate of destroying inflationary pressures once and for all, and as a result, the markets have firmly established a trend downwards, with bear market rallies happening along the way. Now, I don't think I have to remind anyone following on my channel regarding the ominous sign the inversion of the yield curve is giving us right now. And I won't go through it right now as I have done so in previous videos. However, if this is your first visit to my channel and you are unfamiliar with the predictive nature of the yield curve, I would highly recommend you take the time to watch my other video. This is the ultimate indicator of collapse. Everything you have ever wanted to know about the predictive power of the yield curve. With that said, as of October 18th, 2022, we are officially on watch for a recession and subsequent market collapse for the next 24 months until October 18th, 2024. If you have been following my market commentaries up until this point, you would know that we have already taken multiple opportunities this year to reduce our risk in our larger retirement portfolios by lowering equity exposure into the rallies in favor of alternatives and market neutral style funds. And we will continue to pair exposure into stock market rallies as they present themselves until we feel the equity exposure is low enough to curb the volatility. Should a market like the Great Recession present itself, or 2000 and 2003 rear its ugly head, we should be well positioned to take advantage of depressed prices that the markets offer. However, I do think this recession will be slightly different and could take longer to materialize than in previous eras, and here's why. First off, the average interest rate on cash balances in the US has not risen with the Fed funds rate. I touched on this in my last market commentary, and as an update, nothing has really changed in the last quarter despite more hikes happening. The banking system in the US is still flush with cash deposits held by the consumer. As a result, the banks don't need to pay the higher interest rates on deposits in order to attract new capital to lend out to consumers. However, they are collecting the higher interest rates associated with their existing variable rate mortgages and any new loans that they might be doing. You see, the consumer, thanks to massive stimulus in the last few years, has almost $5 trillion in cash. You can see this in this awesome Fred chart. The cash balances for households, checkable deposits, and currency asset levels have never been higher in recorded history. Now, granted, this data is a bit old as it was updated September 9th, but that is still a lot of cash the consumer has to go through. I would expect as this chart gets updated in the new year, cash balances will revert back to the mean. And a lot of people, including myself, believe that these cash balances will probably run out mid-2023. Why? Well, cash eventually runs out, especially if inflationary pressures and higher interest rates have taken a bite out of your purchasing power, and it reduces your ability as a consumer to save. This has led the consumer to come from having one of the highest savings rates in the middle of the pandemic to now a savings rate that is below the savings rate prior to the Great Recession in 2008 and 2009. This chart does raise a large concern as to the health of the consumer and their ability to continue to purchase goods in the economy ahead. In fact, in this article from Bloomberg, Larry Summers describes in detail what could happen with the current tightening cycle. The article goes on to say, while a number of US indicators have suggested limited impact so far from the Fed's tightening campaign, Summers cautioned that change tends to occur suddenly. There are all these mechanisms that kick in, he said. At a certain point, consumers run out of their savings, and then you have a Wile E. Coyote kind of moment. In the housing market, there tends to be a sudden rush of sellers putting their properties on the market when prices start to drop. And at a certain point, you see credit drying up, forcing repayment problems, he added. Once you get into a negative situation, there's an avalanche aspect. And I think we have a real risk that's going to happen at some point for the US economy. I don't know when it's going to come, he said, of a downturn, but when it kicks in, I suspect it'll be fairly forceful. Over the next few market commentaries, I'm going to be monitoring the cash balances and the cash interest rates in the United States to give us some further insight into how quickly things will deteriorate, and we should have an even better picture after the fourth quarter 2022 and into Q1 2023. My forecast is the US does hit a recession and materially slows down. Cash balances will eventually dry up over a 6 to 9 month time frame, and then I would suspect banks increase their savings rate payouts and lending eventually becomes more difficult to do profitably. In the latter half of 2023, in the absence of a Fed pivot, I think we start to see the recession fully materialize, and depending how much the inflation rate has been affected and how slow we are determines the next moves the Fed will make, which could be more accommodative as early as 2023 or even into early 2024. In the short term, I anticipate the markets will continue the downward trend lower into the first half of 2023, given the headwinds it faces. However, there are a lot of moving parts that will happen between now and then. So we shall see how things change. And now it's time for the best part of this commentary. How do you as an investor use this information? What do you as an investor do? Well, as I mentioned in my previous commentary, if you are younger and you have many years to retirement, the next 12 to 18 months should be an exciting time for you, as it is likely you have little in the way of invested capital, and it's likely you will see a lot of red days and sales in the markets. If you took advantage of the dips over the last quarter, continue to do so and continue to take advantage of this time. Focus more on the buying opportunity and less on your short-term performance, as it likely won't look too good for a while. You are probably going to see a lot of great deals on a lot of great companies. Consistently buy on red days and dips, even though there may be more sell-offs and deeper dips on the horizon. It might be very difficult to see fresh money go into the market time and time again and have it go lower and lower and lower. But in the long term, you will likely be very happy you added as much money during a bear market as you did. Now, if you're an older investor and are close to retirement or in the early stages of retirement, this is likely to be a tougher time for you to get through mentally and emotionally. You likely have a sizable amount of capital invested and are not currently working to replenish any principal affected. As I said in my last commentary, you might want to further prioritize preserving your capital at this time if you haven't already. If you have reduced equity exposure over the last quarter, excellent work. Continue to reduce your exposure into any rallies the markets give you and continue to assess your portfolio. If there are any names left over that are of higher volatility or higher risk in your portfolio, look at reducing those positions and purchasing alternatives that have a strong track record during these tougher times. For my clients, my message is we have done exceptionally well during this latest downturn, and this is because earlier this year we have taken several more opportunities to sell into rallies and preserve our capital in the discretionary portfolios that I manage. I've also been working hard to revamp and improve our portfolios by adding additional alternative names in our alternative sleeves, which will hopefully further reduce volatility and likely provide even better risk-adjusted returns. Well, that's it for this quarter, and once again I want to thank you for joining me here at Investing Made Simple. Please hit that like button for the YouTube algorithm, as it really helps out my channel. And if you like my content and you want to be kept in the loop with all of my latest videos, I'd be thrilled if you would just hit that subscribe button and darken that notification bell. Until next time, this is Joe Macek for Investing Made Simple. See you soon.